So you want to know what's happening in the housing market when it comes to pricing, that of will there be a housing crash, and what the heck is going to happen for the remainder of the year. Well, stick around, and over this month's edition of Keeping Current Matters and August National Housing Market Update, I'll cover those three exact topics, which is what's happening with home prices, why there won't be a market crash, and more importantly, what can you expect to happen in housing through the remainder of the year. Well, thanks for sticking around. And remember, as always, hit that subscribe and like button, as every single month we'll bring you what the top experts are predicting is going to happen in the housing market. So let's dive right into what is happening in the current housing market. And for most people, we know that this year has really been a market based off what's happening with interest rates. So as you can see, over the last year, since January, we've seen a large increase in that of the 30-year fixed rate. And reminder, a lot of times when we're talking about the changes in rates, we're really talking about on an annual basis when they rise by more than 1 to 2%. And that is what we saw this year in 2022. But really, when you can look at that peak at the end of June, and that's where a lot of changes in the housing market occurred during that of the end of April, May, and June. And now what you're starting to see is a little bit more of normalization. And we actually, at the beginning of August, saw those sub-5 interest rates on the 30-year. But what we're going to see now, due to the fact that is that the prediction that we saw the peak and it's coming back down? The reality is there's a lot of volatility when it comes to mortgage rates, and this is probably not the peak and coming back down, but most likely this is a good point to start looking at normalization, that this is what we can kind of expect. And over the period of time when you're looking at what you can do when you're shopping mortgage rates, is there are a lot of ways to make sure that you do time some things a little bit more appropriate to take advantage of those periods where rates are a little bit lower. But the topic of rates is really based off the topic of a recession. And as we look at the challenges of the housing market, the rates continue to rise due to the fact of the Fed needing to slow down spending and get inflation under control. Now, just so you know, inflation is the enemy of 30-year fixed rates. So the higher the inflation and the need to get that down, you're going to see an increase in that of the rise of rates. And let's dive right into what is a recession. Now, not to argue with family, friends, or anybody else, but as you look at the National Bureau of Economic Research, they define it as a significant decline in economic activity spread across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. This is the fear for most people, is are we entering a recession? And you may not need to define it as 2 consecutive quarters, even though that's typically what we do. And as you can see with this line right here, is that since 1949, you can actually see the start and the end of every single time a recession was declared, meaning that we have not declared that we are in a recession yet. And unfortunately, until we get those negative 2 consecutive quarter reports, which we'll see over the next couple months, is then we will say yes, and we will declare we are in a recession. But what a lot of people want to know is, well, if this has been going on since 1949, how does a recession impact housing? We're going to stay in our lane. We are real estate experts, and our job to advise clients and customers, and what they ask for us the most is to let us know what's happening in the real world and the impact that that has, though, on what we talk about, which is housing. So as we look at, is there a recession around the corner? If you look at top economists surveying, you can see July of 2021 is only 12%. 1 out of 10 economists said, you know what, yes, we're going to enter recession. But as you can see, what happened over the course of 9 months in that of spending and inflation, and July of last year we saw a massive increase in that number, is you'll see that now 1 out of every 2 are saying, yes, we are going to see a recession around the corner, so let's just better prepare for the fact that we will be in one. And if we are in a recession, what does that mean for housing? So let's dive right into how would housing be impacted by a recession. And as you can see here, if you've been following our Keeping Current Matters and National Housing Market updates, which we put out every single month, and as a reminder, share a comment that you would like to receive that every single month so you have access to the same stuff that we subscribe to and belonging a part of the #1 consulting company in real estate. But as you can see, these slides we've shared several times is that a recession doesn't mean falling prices. Actually, the last 4 out of 6 recessions, we saw prices rise. Now, even when you look at 2008, which was a mortgage crisis, and I'm going to talk about that here in the next 2 slides, we saw a decrease in 20%. When you look at the amount that people have grown their equity in the appreciation rate year over year over year over the last couple of years, is that number now is very small from an impact of what that would mean from people and the overall amount of equity they have. Now, yes, we'd be impacted, but remember, what the market gives, it has to take back a little bit. And right now, we're not even seeing any signs that home prices are going to change. And what do we mean by that? Well, let's look at mortgage rates and that of how a recession impacts them. So if we know that 4 out of the last 6, but really let's call it 4 out of the last 5 recessions that weren't caused by bad lending practices, is that we saw home prices go up. So 4 out of the last 5, heavy prediction with this one that they're going to keep going up. So what happens with rates? As you can see, a lot of times when we enter a recession, housing brings us out of it. And what they tend to do, if you can see going all the way back since 1980, is that coming out of a recession, you will see a reduction in mortgage rates. And in fact, as you look at 2001, 2008, 2020, that number was right around 1% on average, brings us back to where a lot of people are thinking a healthy mortgage rate needs to be, which is somewhere in the mid to upper 4s. As you look at since 1971 on this slide here, you can see the yellow bars are showing the peak of that of mortgage rates rising in a recession, and coming out of the recession, what happened with the rates. So again, the last 6 times we saw rates reduce every single recession coming out of it. That's not a guarantee that's going to happen this time, but it's a high probability that history teaches us we probably will see rate reductions coming out of this next recession. So the challenge with that, though, is over the past 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak seen during the recession. As we look at what that means is on average 1.8, but we take the last 3, it was about 1%. Remember, rates were even a lot higher in a lot of these periods through the 80s and 90s. So what we need to figure out is overall, we're probably going to see rates reduce over time, but not till 2023 and usually till the end of the year after we've gone through that recessionary period. Now, what does that mean though? Is, well, if home prices keep going up and the rates are eventually going to go back down, is you said earlier, why is there not going to be a housing market crash? And we'll dive right into that. Let's first time out and remember, where does inventory come from? There's 3 places that inventory comes from. One of those is sellers deciding to sell existing homes. The other is builders adding new inventory to the market. And then the last one, which none of us want, is distressed properties, meaning those properties in trouble. And so as we dive in this slide here, you will see the total housing inventory registered at the end of June was 1.27 units. Unsold inventory still sets at 3 months of supply. So as you start looking at 2008 through, is every single seller thinking about bringing their home to market. And actually what you're probably going to see over the next couple months is less people bring their home to market because of what they saw in April, May, and June was a reaction to inventory flooding the market. We'll now start to see a normalized inventory level due to, well, let's look at those three things. If not a flood of sellers are coming to the market, and as you look at building permits and housing starts, which remember, that's the second area where inventory would come, is that those are good leading indicators, meaning what's going to lead us to believe that there's a lot coming. And as you can see, that number is not dramatically rising, especially from the permits, especially from the starts, especially with the change of interest rates and the overall market. Now we can look at, though, under construction and housing units completed. The nice part is 1.4 million homes completed this year is greater than we have seen over the last 14 years. So that is a good sign, though. Remember, we've been talking about this over the last couple of years. We need builders' confidence to rise after they went through in the housing crisis. And the challenges with rates is now we're starting to see a decline in permits and starts, which leads us to believe, no, we're not going to see a flooding to the market with new construction. So then lastly, what we have to look at is, will there be a lot of distressed properties coming, i.e. foreclosures? And remember, as you look at the housing bubble, the average index, and what you're seeing in this slide right here is the green line, the higher the line, the higher the index, the easier it is to get a loan. And back in 2005, 6, 7, 8, leading up to the crisis, people could get a loan with no job, no income, no assets. They literally just state what it was. And a lot of jokes back then was it was harder to not get approved for a loan than it was to get one. Meaning that now you can see ever since 2008, 9, 10, we implemented true lending practices to make it very difficult for people who are not qualified and eligible to pay back a loan to receive one. So good lending practices are leading us to believe we're not going to see a lot of distressed properties. But let's really look at the most important report from Adam Data Solutions, which is where are the U.S. properties and foreclosure filings. So as you can see, in 2007 all the way up through 10, we saw millions of filings on an annual basis. And as you look at that number being over a million for a peak of almost about 8 years, is look where we're at now. In 2021, we have only seen 151,000 filings for foreclosure. Now we know in 2020 that number was low, but both those years we had regulations protecting a lot of people from filing foreclosure. But look at 19, 18, 17, 16. Those numbers, if you go all the way back to 2016, were under 1 million filings. And as you look at the first half of foreclosure activity by the year right now, look at us. We are predicting to be at less than 300,000 filings this year, which is actually even better than it was in 2019. So when we really start looking at those three areas where inventory would come from, sellers flooding the market, builders flooding the market, distressed homes flooding the market, is none of those signs are leading us to believe that there's going to be any flooding the market, which means we're finally going to enter what was needed, which is normalized inventory levels, making it easier for buyers to buy and sellers to sell in America. Now, as we look at the other potential distressed property leading indicator would be those that were in forbearance. We've shared this slide a couple times because as you can see, over 82% of people are completely modified, deferred, or out, all right, of the forbearance program. We still have about 17%, okay, that unfortunately are not out of that, but the difference is the amount of equity that they have in their home. They're going to be able to sell their property. And they're going to be able to walk away with equity onto their next plans. We hope for nobody to go through struggles where you have to do that. But the reality is this go round with the amount of equity people on the properties, they do have options. And that's a good thing for people, for homeowners, and another reason why real estate has continued to be a great long-term form of investment. So as you look at a statement here from the Executive VP of Market Intelligence at Adam, He said foreclosure activity across the United States continued its slow, steady climb back to pre-pandemic levels in the first half of 2022. While overall foreclosures activity is still running significantly below historic averages, the dramatic increase in foreclosure starts suggests that we may be back to normal levels by sometime in early 2023. So I'm going to time out for a moment. And when you see the headlines talk about foreclosure activity is on the rise, foreclosure activity is at the highest it's been in 3 years, just remember those slides we shared. Headlines hurt. Their goal is to drive traffic and views, not to provide information. So again, thank you for your time in providing us your ear, your minutes, and we hope to continue to always provide value through subscriptions and services and access to the #1 real estate consulting company in America, as well as the top experts and economists who are truly predicting these things and helping advise you and your family to make a great decision. And as you look at months of inventory to close, is yes, a buyer's market is greater than 7 months of inventory. A neutral market is 6 to 7 months of inventory. A seller's market is below 6 months of inventory. So sitting at 3 months of inventory is an extremely good, healthy market for us to be in compared to the last couple years were unhealthy levels of inventory that led to unhealthy numbers that we had to get under control. And right now, we almost have that under control in our market called real estate. But let's dive into what's ahead for 2022 so that way you can make sure that that control remains and there are good decisions made when you look at your real estate and what you do with it. So mortgage rate projections, as you can see from the Big Four, Freddie Mac, Fannie Mae, Mortgage Bankers Association, and NAR, they're all suggesting that we're going to hover around those 5s we were talking about, with most likely a little bit of volatility based off news, announcement, the feds. And so there'll be periods where you can get great deals, periods where maybe they're a little bit higher. But remember, as you start seeing in the end of 2023, third quarter, fourth quarter, we're starting to predict that rates will dip back down. But the problem is, if you wait, you're going to be paying a lot more, and I'll share that number with you in a second, for the home versus taking advantage of lower prices now and refinancing later when the opportunity is there. So as you look at from CNBC, they're saying there could be a potential silver lining for the market. He added as stabilizing mortgage rates and rising inventory may bring some buyers back to the market during the second half of the year. So the good news for sellers, some of the struggles we saw in April, May, June were market-specific adjustment periods. Now we're getting back to these normalized markets where buyers are coming back out, which is great. And as you look at the home price forecast, they actually jumped up 2% since last month's predictions, which as you can see, home price forecast for the year of 2022, which we still have 5 more months left, or 6 to the reporting, is at 10.3%. Meaning another 5% on the average national home value was still going to see an increase in home prices. Now remember that this is also not taking into account local markets. Some local markets are going to outperform this number dramatically, but also some local markets may see some challenges from that of what they were seeing earlier over the last year or two, which was, let's call it an overheating of the market, and they may need to give back a little bit of what the market did give to them. So as you look at certain markets may be impacted a little differently. If you want to talk to a true trusted top 1% advisor in the nation, let me know and I'll connect you with the top experts. And obviously here, always happy to consult and provide a real estate review to make sure you know what is really happening in your local market. But as you look at, I don't think national housing prices will decline in a meaningful way, but there will be some price declines across the country that is also based off of a month-by-month basis, not a year-over-year. So some of these periods, month by month, we may see a change because of what was impacted from the extreme levels of January, February, and March overheating to where what happened in April, May, June. But remember, we'll start to see more of a normalized market, and in a seller's market, home prices appreciate. And so as you look at to close out today, the challenge for professionals is less home sales, but the nice part for many, when you look at existing home sales, we're still predicting to sell 5.1 million homes as you look at the adjustment through that of June. And when you look at 2017, 18, 19, that's right on pace as they were right around 5.3. last year we saw a very large increase in total home sales due to that of what was happening in the market and the turnaround time of selling homes and how fast they left the market. But as you can see here, very similar in a forecast of what I would call a healthy amount of home sales. And so many people are still participating in the act of real estate. It's just a matter of when they feel right. And we're seeing a lot of sentiment and confidence come back as the timing looks to be very advantageous for both buyers and sellers leading into the back half of the year. So as we close today, 3 reasons to buy a home for some. Obviously, if you don't feel confident in the decision that you're making, you should talk to a trusted advisor. Never rush to the market, but always be in it. Always be learning about it. And here's just some interesting facts as you look at what's happened over the last 90 days. On average in April, the nation was seeing about 5 offers on every single property. Now we're down to 3. That number is continuing to decrease. You're starting to look at fewer homes selling above asking price. 61% were over list in April, all the way down to 50% in June. And some local markets are now actually back to a healthy amount that list price is actually what they're selling at. And as you can see, 2.2, 2.6, upward to 3 months of inventory. As we look at supply, those things are dramatically helping people have some options, not have to rush. But then the other part, as you look at the services that we offer, September 2nd, our fall buyer and seller guides will be available. Remember, all you have to do is check out the channel, and in the bio, you'll see the link to download your buyer and seller guides. However, the most important part is that as an advisor, I want to bring you the news, not just the good news, not just the bad news, but just what is the news. And you have access in the slides to the resources, so then that way you can go check out what are the economists and experts predicting, and you have availability to those resources to make sure that the subscriptions and access that we have as top 1% business operators throughout America, we want to make sure that you have those too, so that way you can make top decisions for you and your family and what comes with your real estate decision making. So from me to you, I hope that you had a great summer. As kids and families go back to school, we're all going back to a little bit of a normalized schedule and lifestyle, and it's great to see real estate getting back to a little bit more of a normalized market, which I think many of you will really enjoy. So stay safe, keep your business moving forward, and I look forward to talking to each and every one of you next month as we bring you September's National Housing Market Update.